Okay, I know what you might be thinking. Realty Income has gone from 45 to 57 and a half now. It's time to sell, right? Well, you might be wrong about that. I think it's got some longer runway to go. I think it's just getting started, really. Maybe up until 70. When the yield starts getting to about 3%, that's what I think about starting selling some call options and things like that. But currently, I think it's still undervalued. If we look at the max chart, you'll see kind of a trend, and we're still towards the bottom of that trend. I'm not just looking at trends, though. Obviously, fundamentals matter. They've gotten bigger in size, and they've had to look for other REITs to swallow in order to grow. But the company's still doing really well, I think. Its growth may have slowed down, but it's still growing. The size is still growing. The FFO per share is still growing. I like to use this website called allreits.com. It has a really concentrated REIT-related data. You should know what a REIT is if you're watching this video, but if you don't, it's a real estate investment trust. Basically, it's a type of company that if you dish out over 90% of your income in a form of dividends, you get preferential tax treatment. The dividends the investor gets, though, the dividends that we get, are non-qualified dividends. So if you make a lot of money on dividends each year, make sure that you look into what that means in order for you not to get taxed more than you should be. allreits.com, I'm not affiliated with the site. I'm just mentioning it because I think they do a great job. Looking through the data here, there's some quite amazing things about this company. First of all, the payout ratio is pretty healthy at 77.9% at the moment. The yield at the moment is also very attractive. It's sitting at 5.46 relative to a 5% yield on a 5-year average for Realty Income. So currently sitting higher than its own average. But also what's even more amazing is that it's actually about 10 basis points, 8 basis points, which is 0.08% higher than all the REITs in the United States, which is crazy to think about because Realty Income is among some of the highest quality REITs that the US has to offer. Even further comparison, the 10-year bond for the US is sitting at 4.23% at the moment. So it's competitive versus that, quite competitive indeed actually, and is going to grow over time. If you leave your money in bonds, they will not grow over time, right? You just get your principal back plus a coupon every year. Furthermore, there are more amazing things about this company, and there's a big reason why this company is 60% of my portfolio. Okay, this is a huge hold. Huge. The rest of it is basically stocks and bonds. Currently, I own some tips and also a bunch of, high paying, high dividend stocks and dividend aristocrats. But 60% is a really big position, and there's a reason behind it. Now, the FFO has been growing pretty well, considering the size of the company now. But what's more impressive than that is that FFO per share is growing. That's what's more impressive. The reason that's impressive is because to do their acquisitions, Realty Income actually issues a ton of shares. I mean, they dilute like crazy. So in order for them to grow FFO per share, that means they're doing some really, really good deals. Now, it's not growing at a super quick rate, but it is growing. Before let's get into it now. So how much is it growing? Well, I'm scrolling down through the quarters of financial reports right now, and it looks like it grew every single quarter. The only one that I see it stayed the same here is 2022 Q4 versus 2023 Q1. It stayed at $3.92 per share. However, every single quarter as far back as 2014, which is what the website will allow me to scroll to, has been growing. And in 2014 Q4, it was at $2.57 per share. And today it's almost double at $4.05 per share. So this company has been growing FO per share for a long time. FFO just means adjusted funds from operation. It's a metric used by those who try to value REITs because there's quite a few ninja financial gymnastics going on within the REITs in order to massage the numbers to make it more favorable for them and the investors. And so that's why this figure is so important. What's interesting is the price over AFFO. It's kind of like the equivalent of price to earnings or enterprise value to earnings when you're valuing other companies. Currently, or at least it closed down Q1 of 2024. Q1 just means quarter one, like the first quarter of the year, at 13.1 price to AFFO, which is pretty low historically. I'm looking at the previous quarter, it was 14.6, previous 12.3, then 15.2, then 16, then 16.2. It got as high as over here I see at 19.1 in Q2 2022. So historically, it looks pretty undervalued. Oh, look at this one. Q4 2019, 22.1. Now that's how you know it's a little bit overpriced. So perhaps at that point, you may want to look into selling some calls. Not financial advice. That's what I do. You're going to have to do your own due diligence and figure out your own strategies. So things I want to mention is debt to assets is extremely healthy at 37.5. Usually for REITs, I prefer it somewhere between 35 and 45, and it just lands right there in the sweet spot. The largest tenant is Dollar General, which comprises 5.7% of occupancy. It's not a big percentage. There are REITs which are much more concentrated than that. This REIT is also geographically diversified a little bit. Obviously, it's very concentrated in the United States. Buildings are 15,028. The next largest country by property numbers is the UK at 291. And then Spain, Italy, France, all under 100. Now, there's a little speck here in South America. I wonder what that country is. I haven't looked it up. It looks like it's somewhere around French Guinea or Ecuador or something like that. So I'd be interested to see where those properties are and what was the decision-making process like when they decided, hey, maybe we should diversify in South America. So let's take a look. All right. Now, looking at the dividend history, it's pretty apparent that they put a really high priority on always increasing the dividends. I look back in the history and they increase them pretty often. They almost every quarter, like every other quarter or so, they'll do a small increase. Every once in a while, they do a pretty large increase of like 2% or something like that. But usually they increase the dividends by about 0.02%, which is not huge, but it will keep pace with inflation. And if you reinvest the dividends, you get, some capital growth in there. And so I really, really like the company. It may get beaten sometimes by the S&P 500. I'm not sure who's winning on which time frame right now, but there's periods of time where the S&P wins with reinvested dividends, and there are periods of time where the Realty Income stock wins with reinvested dividends. So that's going to have to be, personal choice. Now remember that these dividends are not qualified dividends. So you will not get preferential tax treatment for them. No REITs get qualified dividends. The only one that I know that has partial, I don't even know what that means, is LTC. So if you're interested in that, you can go look up that company and see if that works for you. But you're going to have to do your own due diligence and your own homework on what exactly their dividends look like, how they're treated, etc. Now, what my plan is here is to continue hold this, hopefully like forever. But I'm going to use the dividend to either reinvest back into the company or make other purchases. Right now, I'm in this trend where I want to construct my portfolio so I'm getting a dividend every week just because it just makes me feel good. So I've actually asked ChatGPT to construct a portfolio of dividend aristocrats where I could get paid weekly. And I took some of those ideas and applied them. So my account currently looks like a little bit of a mess. It had literally one or two positions just a week ago. I just had Realty Income and then Lee Auto. I've sold most of that position through call options, but now I'm actually trying to get back into Lee Auto. I made a video about it. If you're interested about Lee Auto, you should go check it out. Other recent videos I've made is Medical Properties Trust update. So if you want to look at that, do it. It's Medical Properties Trust actually having a really nice day today. But what I say in the company video is that I think the company will survive, but it's going to be, a drag. So I actually exited the company more for other reasons. I just don't like the way the company's managed and I can't trust them, but it's having a really nice day today. It's got a lot of assets, so probably go up. I don't know what's going to happen to the company. It depends, but you should go check that video out if you're interested. So Realty Income, 60% of my portfolio. Let me know what you think about the company. Do you have a position? How long have you had it? Are you automatically reinvesting dividends? Is it part of a grand strategy? Also, if you disagree with something I said on the video, please comment below. This is the main reason I do these videos, is to learn from you guys. I'm looking for ideas. So please let me know in the video or in the comments below what you think and what I got wrong, if anything. All right. That was fun.